Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. Geneva hosts dual high-stakes talks, Russia, Ukraine, and US-Iran. 2. Japan Q4 GDP at 0.2% annualized, far below consensus. 3. RBA hikes to 3.85%, anchoring global policy divergence narrative. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily Market Briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. Geneva hosts dual high-stakes talks, Russia, Ukraine, and US-Iran. Primary asset classes impacted: energy complex, Brent, WTI, European defense equities, EUR/USD, gold and safe havens, VIX, UST10Y. What happened? Geneva hosts two simultaneous geopolitical negotiations today. US-mediated Russia-Ukraine trilateral talks begin with Medinsky leading Russia's delegation and Umarov heading Ukraine's. Separately, US envoys Witkoff and Kushner hold Oman-mediated indirect nuclear talks with Iranian FM Araghchi. Both sets of negotiations occur as US military prepares for possible weeks of operations against Iran, and Russia continues strikes on Ukrainian energy infrastructure. Why it matters? Two active conflict negotiations running concurrently in the same city create compounding binary risk for energy markets. Russia-Ukraine progress would ease European energy risk premia and support euros, while failure keeps defense equities bid and maintains Bund safe haven demand. US-Iran dynamics are more acute. Witkoff has stated that failure to yield results will end diplomacy and trigger alternative options, while Pentagon prepares operational plans. Iran's refusal to halt enrichment and US insistence on facility dismantlement at Natanz, Fordow, and Isfahan leave a wide gap. Oil prices embed an estimated $2 to $3 geopolitical premium. Key numbers to remember. Russia-Ukraine, third round of trilateral talks. US has set June deadline for agreement. Territory remains core dispute with Russia demanding Ukrainian withdrawal from Donetsk. US-Iran, Witkoff stated enrichment facilities must be dismantled. US has deployed second carrier strike group with operational plans for weeks of strikes if talks fail. What to watch next? Any framework language on ceasefire or enrichment freeze would trigger immediate oil sell-off and risk-on rotation across European equities and euros. Conversely, walkout from either negotiation table would spike Brent above $65 and lift VIX, defense equities, and gold. Witkoff and Kushner participate in both tracks today, creating linkage risk where failure on one front contaminates sentiment on the other. Tuesday afternoon timing for Russia-Ukraine session means European close will partially price initial signals, while full US session captures both outcomes. Weekend German election adds a political backdrop that amplifies European sensitivity to any Ukraine progress. 2. Japan Q4 GDP at 0.2% annualized, far below consensus. Primary asset classes impacted: Japanese equities, Nikkei 225 topics, JGBs, 2Y, 10Y, 30Y, USD/JPY, BOJ rate expectations, Asian FX, broadly. What happened? Japan Q4 GDP grew just 0.2% annualized, sharply below 1.6% consensus, barely recovering from Q3's 2.3% contraction. Capital expenditure rose only 0.2% versus 0.8% expected. External demand contributed zero growth as US tariffs and a Chinese boycott over Takeichi's Taiwan rhetoric weighed on exports. Private consumption grew 0.1%. Nikkei surged 3.9% Monday to a record above 57,000 on fiscal expansion expectations, following Takaichi's supermajority election win. Why it matters. The severe GDP miss strengthens Takaichi's mandate for aggressive fiscal stimulus, with sales tax suspension on food and supplementary budgets likely accelerated. BOJ rate hike expectations have collapsed, with March probability at just 4 basis points and July now the earliest expected move. The JGB curve steepened as the 2-year yield fell on easing expectations while the 30-year rose above 3.49% on fiscal supply concerns. The combination of fiscal expansion and stalled monetary normalization creates a structurally weaker yen, with USD over JPY rising 3% over the past week. China's boycott represents a new structural headwind that fiscal policy alone cannot offset. Key numbers to remember. Q4 GDP at 0.2% annualized versus 1.6% consensus. CapEx 0.2% versus 0.8% expected. Full year 2025, GDP at 1.1%. Nikkei hit record 57,110 Monday, up 3.9%. JGB 30Y, above 3.49%. BOJ March hike probability collapsed to 4 basis points. Takaichi's LDP won 316 of 465 seats. Coalition supermajority of 352 enables constitutional override and unconstrained fiscal expansion. What to watch next? Takaichi's first fiscal policy announcements will determine scale and timing of stimulus, with a supplementary budget possible in Q2. The China boycott of Japanese goods and tourism represents a structural growth drag that markets have not fully priced, with potential downside to export-dependent sectors. BOJ March meeting is now a non-event unless data improves dramatically. USD/JPY direction depends on whether markets prioritize growth-supportive fiscal stimulus or debt sustainability concerns from combined loosening and stalled normalization. JGB 30-year yield approaching 3.5% could test BOJ tolerance for long-end steepening, potentially triggering intervention signals. 3. RBA hikes to 3.85%, anchoring global policy divergence narrative. Primary asset classes impacted: a UD/USD and AUD crosses, Australian rates and bond curve, global FX carry dynamics, EM rate-sensitive assets. What happened? RBA minutes confirmed the February 3rd decision to raise the cash rate 25 basis points to 3.85% was unanimous, citing a material shift in inflation and employment outlook. Trimmed mean inflation was revised sharply higher to 3.2% for end 2026, well above the 2 to 3% target. The board noted private sector demand recovered faster than expected, and labor market tightening had paused or reversed. RBA stated there is no predetermined path for future rates. Why it matters. Australia is the first G10 central bank to resume hiking in 2026, creating a stark policy divergence with the Fed and ECB where markets price cuts. The unanimous decision and upgraded inflation forecasts signal this may not be a one-and-done move, with implied quarterly trimmed mean inflation at 0.9% for the next 2 quarters, suggesting persistent price pressures. AUD/USD dynamics now reflect widening rate differentials favoring Australia versus the US, where the 2-year yield has fallen to multi-year lows. This divergence complicates the global disinflation narrative and raises the question of whether other central banks face similar second-round inflation risks. Key numbers to remember. Cash rate raised to 3.85% from 3.60%, unanimous decision. Trimmed mean inflation forecast upgraded to 3.2% at end 2026. RBA expects quarterly trimmed mean inflation of 0.9% for next 2 quarters before moderating to 0.7%. Return to mid-target by mid-2028. Rate hike reverses 2025 easing cycle. First G10 central bank to hike in 2026, widening policy divergence with Fed and ECB. What to watch next? Australian employment data and quarterly CPI will determine whether a second hike enters the pricing. The RBA's emphasis on no predetermined path keeps optionality open in both directions, but the inflation forecast upgrade suggests the bar for pausing is high. A UD/USD sensitivity to US data remains elevated, with Wednesday's FOMC minutes potentially widening the divergence narrative. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.